79%. That's how many institutional investors, sitting on $30 trillion combined, are already bracing for a correction this year. Not a rumor. A survey of the people who actually move the market. I'm not going to tell you a crash is coming in 2026. Nobody honestly knows that, not even after 40 years of doing this. But I've sat through the last 3 that did happen, and there's a number in here that even surprised me. I'll get to it. 40 years in this business. I sat through the dot-com collapse in 2000. I sat through 2008. I sat through 5 weeks in 2020 that erased a decade of gains and handed most of it back within a year. And the first thing I'll tell you isn't what you're expecting. I never once got the timing right. Not the depth, not the date. Neither did anyone I worked with, including people paid a great deal of money to know better. I'll tell you why I actually care about this, and not just as a numbers exercise. In March 2020, I was mentoring 2 people at the same firm. Similar salaries, similar portfolios, both around $340,000 going into that year. One of them panic-sold everything, sat in cash for 8 months, and never fully got back in. The other did nothing, no plan, just froze, and by accident rode it out. Same market, same 5 weeks, same 18 months of headlines. 6 years later, one of them is roughly double what they started with. The other still hasn't caught up to where they were before the crash, still sitting on paper losses from that 5-week window, 6 years on. Same intelligence, same information. The only difference was what they did in 5 weeks in 2020. Here's what's actually verified today. Not speculation, just the numbers I check every morning. The VIX, Wall Street's fear gauge, is sitting around 27. Its long-term average is closer to 20. The Buffett indicator, total market value against the size of the economy, is near 221%, historically a level that's preceded trouble. The last time it sat this high, the S&P went on to enter a bear market. The Nasdaq officially entered correction territory earlier this year. And 4 days ago, South Korean stocks fell sharply over 2 straight sessions, enough that U.S. analysts are already pointing at it as a live example of how fast sentiment can turn. I want to be precise about what those numbers actually are. Stress signals, not a forecast with a date attached. I've watched people confuse the two for 4 decades, and it's cost them more than the crash itself ever did. So let me tell you what actually happened to people who weren't positioned for it, 3 separate times. 2000, the Nasdaq fell close to 78%, peak to trough. 2008, the S&P fell around 57%. 2020, the S&P fell about 34%, but in 5 weeks, faster than either of the other two. Nobody rang a bell at the top any of those 3 times. The warnings for 2008 started back in 2003, 2004, 4 full years before it actually hit. The dot-com warnings ran from 1997 all the way to 2001. If you wait for certainty, you wait too long, every single time. Here's the number that actually surprised me. It's not how far markets fell, it's how fast they came back once they turned. The Nasdaq didn't reclaim its dot-com peak until 2015, 15 years later. 2008 took a little over 5 years. 2020 took about 6 months. The recoveries have been getting faster, not slower, which tells you the real risk was never the crash itself. It was jumping out during it and missing the recovery entirely. This is where I have to stop myself and ask the real question, because it's not the one most people ask. I never once got the timing right. Not once in 4 decades. What actually mattered all 3 times wasn't whether I saw it coming. It was whether I was already positioned for it before I needed to be. That's a completely different question, and it's the only one that's actually answerable in advance. Diversification isn't a buzzword to me, it's math. When equities drop, bonds and cash typically don't move the same way at the same time. A portfolio split across asset classes absorbs a shock that a 100% stock portfolio takes directly full force. Here's what that cushion is actually worth. During the 5 weeks in 2020 I just described, the S&P by itself fell about 34%. A 60-40 split, 60% stocks, 40% bonds, fell about 22% over that same stretch. Real historical numbers. On a $100,000 portfolio, that's the difference between dropping to $66,000 or dropping to $78,000. $12,000 of difference from one decision made years before anyone knew 2020 was coming. And leverage does the opposite of cushioning. It amplifies. Under FINRA's standard rules, a margin account needs to hold at least 25% equity relative to what you own. Say you put up $20,000 of your own money and borrow another $20,000, a $40,000 position, 2-to-1 leverage. Run the math, and a drop of about 1/3, roughly $13,000 off that position, is exactly where the 25% floor gets hit. You're left with $6,600 in equity against a loan that hasn't shrunk at all. Some brokers set their own requirement even higher than that, which trips the call even sooner. Either way, it forces you to sell at the worst possible moment or lose the account entirely. That's not a 2008 story. That's true on any ordinary bad week. And on timing your entry, dollar cost averaging doesn't guarantee you a better price, whatever anyone tells you. What it actually does is remove the single worst risk there is, putting everything in at once, right before a drop, because you convinced yourself you could guess the bottom. So here's what I actually do, in order, regardless of what 2026 turns out to be. 1. An emergency fund, 3 to 6 months of expenses, sitting in cash before I touch anything else. That's what keeps a downturn from forcing you to sell investments at the bottom just to cover rent. 2. I check my actual leverage. Know exactly what drop triggers a call and decide now, not during the drop, whether that's a risk you actually want to be carrying. 3. I diversify across asset classes, not just across stocks. 10 different tech stocks isn't diversification, it's concentration wearing a disguise. Stocks, bonds, and cash actually moving differently under stress. That's diversification. 4. I decide my plan for a 20% drop before it happens, never during it. I write it down. 5. I rebalance back to my target mix once a year, not more often than that. The people who panic sell aren't irrational in my experience. They just never decided anything in advance, so fear made the decision for them instead. And I want to be straight with you on this. I'm not a licensed financial advisor giving you personalized advice. This is what 40 years and 3 crashes actually taught me. What you do with it from here is entirely yours to decide. In 2008, I didn't call the bottom. Nobody I respected did either. What I had was 6 months of expenses in cash, a portfolio that wasn't leveraged to the edge, and a plan I'd written down before the panic started, not during it. That's the whole secret, and it's a boring one, not a prediction. A checklist, done early, by someone who assumed he'd eventually be wrong about the timing, because I always was. If this kind of thing is useful, not predictions, just what actually holds up under pressure, hit like and subscribe if you want more of this. Next time I want to take apart the thing every finance video tells you is magic: compound interest. Why it actually fails 90% of the people counting on it and what the other 10% do differently. 2 days.